Now, here's where we're at with the S&P 500. We've seen the February top. We lost the 50 period. We lost the 200 period moving average, and we've gotten this death cross. We've moved all the way down to horizontal support in the weekly time frame. I covered in my last video, and we ended up dropping over 21%. After that low, we got a bottoming tail at horizontal support. Trump paused the reciprocal tariffs the day of the launch and went to a base rate of 10%. Negotiations started happening. The historic rally on the S&P 500 got a little bit of a pullback, rallied it back up to test it, couldn't clear it, and then now here we are. So we've pulled back. The pullback the following day was to just under the 50% retracement of the entire advance off of the low. We establish a higher low. Again, you can have an ABC move here. I talked about that Elliott wave count in my previous update. I talked about the different abilities for the Elliott wave count. Elliott wave is speculation. And what good is it? Because counts, you can have counts, bullish and bearish counts, and different counts can get invalidated. Watching this move, do we have a 5-leg push lower or a 3-leg push lower? Well, so far it looks like a 3-leg push lower, which is corrective. This low can hold, then again, likely going to new highs. So just looking at different possibilities. Now, still pull back and get a deeper retracement. Even if we establish a higher low, the golden pocket is down here, down between on the S&P 500, 49.67 at the 78.6 Fibonacci to the 5,072 area, 61.8 Fibonacci. If we get a more shallow retracement, here we are. Again, we've dropped here to the just beyond the 50% retracement. Rallied up and now hovering, bouncing off of the 38.2% retracement. But we've seen just over 50% retracement the following day after that historic rally. And we establish a higher low. If we take out this level, then again, this low comes into play. Again, you take out the golden pocket here, then again, this low is taken out. You're going to those 200-week moving averages I talked about in my last update. That's where we're at. We've dropped just over 21%. We've rebounded back up by over 13%. A bullish piercing candlesticks in the weekly time frame that I'm talking about in this video. They need to be confirmed, and if they are confirmed, we'll eventually need to get back above the 200 period moving average here. But we could end up trying to rally up towards the 250 period moving average. Again, if you do that, you've got that possible inverse head and shoulders pattern. And again, it may be a slanted neckline or go higher and slant upward, sloping higher. So again, or horizontal if we come back here. But can we move towards the 200 or just underneath it there? Again, we'll be watching to see if we can recover further. Now here's what's going on with the NASDAQ. We again had that failed breakout back up at the February top. We couldn't clear, we got above the December high, but you couldn't get a follow through. We had the sell-off. We dropped and lost the 50, the 200, rallied back up, got rejection at the 200, and then we saw this drop surrounding Trump's tariff liberation day. We have the launch. Trump paused the tariffs. We had the historical rally. And then we're pulling back off of that rally. Now, after this decline right here, we ended up dropping about 25.5%. From that low, we rebounded back up, and we rebounded back up over 16%, 16.34%. And the pullback, an inside day that's not been confirmed, and the inside day took us back again to the 50% retracement of this advance. So that's where we're at right now. We could still go deeper into the golden pocket, which is between the 61.8 Fibonacci, 78.6 Fibonacci down into this range right here. And again, just like the S&P, we're just under that 50% retracement, and we rebounded back up. And so far that low is holding as a higher low. But if we get a deeper sell-off, the golden pocket between 17,098 and 17,533 is the golden pocket for NASDAQ. Again, take out these lows. You got the 200-week moving averages, but you have those bullish piercing candlesticks in the weekly time frame that might mark a bottom. Need to see those candlesticks confirmed with a much larger rally. Again, you still have the possibility that if we get the massive rally back up to the 200 and the 50, again, just overthrowing it or coming up to just under it, getting a slanted neckline or horizontal neckline or sloping higher, above this level, you have the possibility of an inverse head and shoulders pattern with a V-shaped recovery. And then we come back and then we get a right shoulder and then it's off to the races. Would measure taking us to a new all-time high. Could have a V-shaped recovery on your hands. We just may not know it yet if we can rally. What could cause a massive rally? Certainty. It's caused a sell-off. Uncertainty. The market doesn't like uncertainty. We hear of an agreement to negotiate, and again, based on some of the reports from Zero Hedge and others now, President Trump has just said China and the United States could be in secret talks negotiating behind closed doors already. That's what it looks like, or is being suggested as a possibility from the Zero Hedge article. Others are now covering that. If it's announced that, hey, okay, they're going to go into formal negotiations and Trump announces he's going to pause the tariffs, or some of them, or reduce them, pause them 90 days like he just did with the reciprocal tariffs, markets would rip higher. Could cause that. I think you're going to see that happen. We're being told there's no way. I've posted on social media that I think that that's likely going to happen in the not too distant future. I've been called every name in the book for daring to suggest that that is a possibility because people do not believe that it's going to happen. Media is telling us it's not going to happen, and that and we see now, what is it? 180 countries the tariffs were aimed at, and you have majority of the countries now lining up to have negotiations or already in negotiations. We had Trump and Mexico, Trump and the president of Mexico talk this week. We had a delegation from Japan. We've already seen other countries move towards negotiations. We just had the prime minister of Italy. There are others that are talking. Europe has delayed retaliatory tariffs. All the stuff the media told us wasn't going to happen. Just moving now into the next Great Depression. I'm just telling you, again, you're going to get deals. You're going to get tariffs going away. Eventually, China's going to come to the negotiating table, and the markets are going to rip higher, likely going to recover. Even if the market's top, which I don't think it has, again, you're going to get a larger retracement of all of this. In all likelihood, you're going to come back up to test the 200-period moving average at some point in all likelihood. Already had the 16% rally here, a 13% rally on the S&P 500. The bears told us there's no way that was going to happen, and yet it did. I talked to you before Trump paused the tariffs on the launch day. I told you, again, he could do that. Deals reached. The Trump paused the tariffs. He already did it with Canada and Mexico, and then he slapped on the tariffs, and then he walked it back, and he said everything covered under the USMCA agreement, previous agreement there, these tariffs don't apply. So again, most of the tariffs back. I told you we could see something like that, and we did. Trump did the same thing in 2018. Again, he slapped on tariffs, paused them as negotiations were happening. We've seen this before. I'm just telling you, if we end up seeing China announce formal negotiations with the United States, sending a delegation. Again, it looks like it's being done behind closed doors at this point in privacy. Trump's talking here as I'm making the video here on Good Friday. It sounds like he's talked to them. So we get Trump soon pausing the tariffs, and again, the two parties coming to the negotiating table have a cooling off period with pausing the tariffs. I think that is very, very likely. We're being told there's no way that's going to happen. I've been called names. I've been verbally abused, attacked, and told how stupid that is, that there's no way that's going to happen. So don't tell me that people does happen. Oh, everybody saw that was coming, because I'm telling you, doesn't think it's going to happen. Roasted alive social media, when I post anything about that China's going to be come to the negotiating table, the herd doesn't think it's going to happen. And when everybody thinks something isn't going to happen, it's likely going to happen. And the media is telling us, it's over. Run around and cheerlead for the next Great Depression. Pretty incredible. Thus, I digress. I'm going to show you the drop, 25.5%, the rebound up just under 16.5% on the NASDAQ, and then we're looking at these Fibonacci retracements. Again, you can establish a higher low here or at the golden pocket. Again, we could try to make our way towards the 50 to 200. If we get a V-shaped recovery here, we may not get much of a pullback. We may not get a golden pocket pullback if we attempt this V-shaped type of recovery, which so far that's in play at this point. I just want to talk about the other death crosses in the bull market. We've had 4 times, we've just dropped 21% on the S&P 500, or just over 21%. We've had 4 other times where we've dropped 20% or more. 2011, 2018, 2020, and 2022, and then now. The 5th time we've had a 20% drop if the bull market is going to continue. So this market has had this happen before. Are these just bear markets? No, they're not. These people that define a bear market by a 20% drop are just missing it, because if we've had 4 previous times where we've dropped 20% or more. So we've had, 4 bear markets. It's really a goofy way to define a bear market. 100-week moving average and the moving average dropping below those levels do a much better job, or again below them and staying below them. Here in the daily time frame, we've had drops below the 50 and the 200. We've had death crosses before, but yet we recovered. After the bear market, we had the 50 drop below the 200. The 50 stayed below the 200 the entire time. In the bull market, we've had periods where we've dropped, the 50s drop below the 200, prices drop below the 200, didn't remain there. Here with the flash crash, we dropped 17+%. The 50 dropped below the 200 period here in 2010. We got back above it. We went to the 2011 high. We ended up dropping 21%. After the 21% drop, again, we had the 50 drop below the 200. We ended up getting back above the 50, eventually getting back above, struggling. We tested the 200, eventually getting back above it. 50 got back above it. The advance resumed. 2010, 2011. This is one of the times right here where we had a drop of greater than 20%. We dropped 21%, and yet the market still recovered, and that's likely what we're going to see next. Another death cross here in 2015 and 16, where we had the death cross. We ended up dropping. We dropped down. We recovered back up to the highest, and then we had another drop. We ended up dropping 17% or so, just over 17%. But the 50 got below the 200. Eventually, we got back above the 200. The 50 got back above the 200. So again, even though that wasn't a 20% drop, you've had the death cross and the recovery surrounding the death cross, 2015 and 16. And again, in 2018, we had a 20% drop. Again, this is associated with bear market, 20% drop, but yet we got back above, and it was just over a few months. This is surrounding Trump's tariffs. It recovered, bigger drop, and then the market recovered again. Ended up getting back above the 200 period in 2018 after 20% drop. The 50, we got back above the 200. We had the death cross, but we recovered. The same thing with the pandemic. We sold off 35%. Is that the shortest bear market in history? 3.5 weeks? No, it's not. It's part of the larger bull cycle. Crash move in the larger bull market. Major sell-offs that have happened with it. Here we dropped 35%. We rebounded back up. We saw the death cross. We rebounded back up above the 50, above the 200, and eventually got the bullish cross. This is likely what we're going to is some kind of recovery back above the 200 period moving average going forward. 2018, 2020, 2022. We lost the 200. We lost the 50. Ended up getting back above them, but then these bigger sell-offs rallied to the 200, got the bigger sell-off. 50 remained below the 200 period moving average. This is a major correction. These sell-offs are major correction. Sometimes the death cross can mark a bottom just the price will bottom out just before the death cross or just after it. Other times it could be a major correction, like right here in 2022 and some of these other corrections. Times it leads to the bear market, like I showed you at the start. 50 dropped below the 200 and remained below it. Ended up moving into a longer term bear market there after the financial crisis. Here in 2022, the death cross, eventually we got back above the 200 period moving average, back the 50 got back above it, and again it's been above it up until now. Now we've had the death cross here. Now directly below is our 200 week moving average in the weekly time frame. We lose that level, stay below it, that's going to be extremely bearish. We bounce here or go down to the 200 week and bounce off of it, one or the other, just above it like we did back in 2023, and this is a daily 200, not the weekly, but again, then it could mark a bottom. Death crosses sometimes mark bottoms. We bottomed before we got the death cross. It very well could be that we bottomed just before it or we bottomed just after it if we go down a little bit further to the 200 week moving average, but we did get a bullish piercing in the weekly time frame. I wanted to show you we've had multiple times where we've gotten death crosses in this longer term bull market, and we've recovered. We've had 1, 2, 3, 4, 5, 6, and now 7. We've had 6 times previously where we've had a death cross and we have recovered associated with a major correction. I think we're going to recover. I think we're going to move to new highs. Then I think we're going to top. We've had 6 times previously where we've had a death cross and we've recovered, and 4 times where we've had a drop of 20% or more and we recovered. Could we see it with this time around? I think that is likely going to be the case. I want to wish everybody a happy Easter. I hope you had a good Friday. It was closed for Good Friday. We got some interesting sequence count signals in the weekly and the daily time frame on the S&P 500 completing this last week of trading. I want to check that out. If you haven't watched that already, I'll link that video at the end of this one. I'll cover some things I didn't cover in my last update on Friday, Thursday after the market closed. I'm posting this video on Saturday rather than Sunday. I know people are going to be spending time with their families for Easter, taking kids and grandkids on Easter egg hunts and going to services. So I'm posting video on Saturday rather than Sunday. The Dow was down. United Health Group earnings dragging the Dow down. United Health dropped 22%, and that weighed on the Dow, dropping 1.33%. Remember, the Dow is only 30 stocks. S&P squeaked out a gain, 7 points, up 0.13%. NASDAQ was down the same, 0.13%, just lower. The S&P slightly higher. The Russell beat them all, and it was up nearly 1%. There's a lot of concern, Trump might try to replace Powell. Whether that's possible, I'll leave that for the experts. Again, the tension continues. Trump wants to have rates lowered. Powell's worried about Trump's tariffs causing inflation, and so Powell's all worried about inflation soaring. Again, tariffs do not cause inflation. I don't like Trump's tariffs. Okay, I don't like anybody's tariffs. I don't like tariffs. I believe in free trade. Powell believes that the tariffs are going to cause inflation. He believes that Trump's tariffs are, extremely high. They're going to cause, a recession and inflation, and it's just going to be horrible. Again, put on your thinking cap. We've had Asia, we've had Europe, countries with countries in and Europe, extremely high tariffs. Why are we not seeing hyperinflation? Why are we not seeing in those countries? Why are we not seeing them in permanent recession? If everything we're being told, so Trump's tariffs cause inflation, Trump's tariffs cause a recession, but none of these other countries that do it. Just one of the many arguments. Makes absolutely no sense at all. Now, possibility of rattling markets further. We'll see what happens with it. Personally, I don't think anything's going to become of it. I think the Fed is going to end up doing emergency cuts. We're going to have another rally, probably going into the summer, maybe the fall. Final phase of the blow off top, and then we're going to see a drop, and it's probably going to be even more dramatic than what we just witnessed, the 21% drop in the S&P 500. That's when we're likely going to get the Fed panicking, and we'll get the emergency rate cuts. Trump will get what he wants, but we're going into recession. Powell will eventually do that. The Fed's making the exact same mistake that they made back in 2007. Again, they're so worried about inflation when they should be worried about a recession. Remember Powell back in December telling us that it's clear we have avoided a recession. Now, this week, he gives a pretty bleak outlook on the economy based on the tariffs and so forth. And I continue to say it. These deals are going to be reached. The tariffs are going to go away. And in many cases, likely going to see, again, China coming to the negotiating table. President Trump has now made hints that he's in talks with China. Zero Hedge broke the story that Trump be in secret negotiations with China. Just appointed that new trade negotiator just this week. Was asked directly if he had talked to China's president, and he declined to answer. But again, a speculation around that, and with the Zero Hedge story that others are now. We continue to have extreme fear. We had a reading of 4. Come up now. Here we are at 21. We've been bouncing around a little bit, holding at extreme fear. So again, if we attempt to rebound back up to the 250, we'll likely see it move even higher back up into the fear reading. Top back in February, we never broke 50. We never broke above this level. We never moved into greed or extreme greed. You're likely going to see that happen. And if the market is topped, you're likely going to get a massive Fibonacci retracement. But I doubt that it has topped. The risk is we still go down and get one more push lower to the 200-week moving averages. I talked about that in great length and detail in my last video, and earlier in the week I've talked about the 200-week moving averages. We're bouncing off horizontal support. We may not reach those 200 weeks. At the 2023 low, we never did. Major pullbacks, we didn't. We've seen the April 7th bottom. We saw the extremes here. We saw that reading of 4. Moved up off of it. Now we're, in the 21 level. I think we saw a moment ago. At above 25 here, 25 or higher, we go into the fear and move out of extreme fear. We'll be watching that. Now again, you either have these extremes where you form divergences at extremes. Now here I have the fear greed index in blue. The S&P 500 is in red, and again they move down here to extremes. We hit horizontal support. S&P from the 2022 high. I talked about that in great length and detail in my last update, and we came down and we reached this extreme on the fear greed index here in blue. Now, at deep extremes, reading of 4. You bottom, either get the extremes or you get a divergence at an extreme. Back over here, the 2022 sell-off, we ended up getting a divergence, got a bounce, and then we got a larger divergence that ended up setting up here that marks a bottom during the summer of 2022. Ended up that we had a big rally, but then it failed. It was followed by another 20% sell-off. We ended up, getting these rallies. You had a couple of big rallies, and then it was followed by major sell-offs, and then we formed another divergence here between the fear greed index and the S&P. That actually marked the bottom, the 2022 bottom. The market recovered, moved to extremes again. After we recovered, we sold off, and again this extreme marked a bottom. At the 2023 bottom, we had a divergence between the S&P 500 and the fear greed index. First major sell-off in 2024. We came down towards it, didn't quite reach it. No divergence, just an extreme. That was followed by a big rally back up to the July peak of 2024, and then we came down, and again, no divergence, just an extreme. Off from the December high down to the January low was a divergence. Low before this bounce right here marked marked an extreme. So again, you can see, and here we've had an extreme. So do we end up forming a divergence and go down to the 200-week moving averages, and then we bottom out, which is directly below our previous low? Or do we have a bottom in with the 9 counts that we got leading this past week with our sequence counts? I've talked about that in my last update. Just wanted to show you again, we've had this extreme. And again, this is a deep, deep extreme. Possible that can hold as a bottom with the extreme reading we got, or again, a divergence. Price moves lower, but the fear greed index ends up getting a higher low. That's the risk here right now. Happens, it's very likely that we would bottom surrounding our 200-week moving averages, although like I said, times like at the 2023 low, we never did reach the 200-week moving average, and other times during the bull market, you came close to it or tagged it, moved just beyond it to find a bottom. In 2023, we never reached it. Do we have something like that, or do we tag it? To have a bear market, you got to take out the 200-week moving average, as I talked about in my last update. Now, we could get a divergence here if we form one on the RSI, if we get one more push down, if we form one on the RSI, the MACD in the daily time frame, the RSI in the daily time frame, and the awesome oscillator. I've talked about that at great length and detail. You don't need to form a divergence, but you still could. That is the risk, and if we do, it's likely going to be at the 200-week moving average. If our lows and horizontal support hold, we need to clear the 20-day moving averages and the daily time frame to try to move back up to the 50 and the 200, which just recently got a bearish death cross for both NASDAQ and the S&P 500. Just quickly, the AAII sentiment survey shows again that bearish sentiment is just extremely high. A lot of negativity out there. No hope. The herd has lost hope. We're going to be watching. Did we get a bottom there on April 7th? Now set up a higher low. Go back and get one more push lower and then bottom at the 200-week moving averages, again, which I talked about in my last update. Directly below those lows. So again, bottomed, we need to rally above our 20-day moving averages and eventually gravitate to the 200 period and try to get back above it. But bearish sentiment is through the roof, and again, we're at the levels where we saw the bottom. I mean, we're at the extreme levels where we saw the bottom in 2009. Now again, I do believe we're going to have a bear market. This is the preview of coming attractions. The market suggests we're going to still make new highs. The yield curve is suggesting we're still going to make new highs in a very large topping process. Dropped 21% on the S&P. The Fed hasn't panicked. I believe that the bottom and begin to rally new all-time highs. Stock markets come up off the lows. The credit market has come down off of the highs. Again, this is what usually happen as you start to see stress in the credit markets. It calms down. Market ends up rallying up to a new high. This is what we've seen in the past. I've talked about this over here during the financial crisis, over here, the bursting of the tech bubble, over here again with the tariffs in 2018. It calmed down. We went to new highs, and then eventually see the markets peak after the new highs and stress in the credit markets, and later the black swan event. So again, this is the playbook that it's following. It's doing the same thing that it's done before. So I think you're going to see a recovery in the market, but then a larger topping process. I believe that this is the wave 4. We fall by wave 5 to new highs. We're being told now there's no possible way that's going to happen. Looking at the history of the credit markets, that's usually the way it happens. We did see that big spike in the equities put to call ratio when we came down and made the low April 7th. It was a spike in the put to call ratio to extremes that marked that previous low, the January low, and 2024, the August low and the September low. We saw a big spike in the put to call ratio. So again, the question now is, can we establish a higher low, or do we end up setting up a divergence on the RSI, MACD, and the awesome oscillator, and even the fear greed index? The spike in the put to call ratio, could that have marked this as a bottom? And very often that is the case. Something worth paying attention to. Now, the risk is the S&P goes down and tests the 200 period moving average. Again, we did get a 9 count signal. Sometimes you go a little bit lower than the 9 count. Other times the 8 or 9 bar acts as a top or a bottom. In case it would be a bottom. What happens? If you see a spike in volatility, if the S&P does go lower for a divergence scenario, then again, the VIX will likely not move to a new high. Again, often they diverge. But again, we may not move to a new low. We may be establishing a higher low at this time, either here or at a little bit lower levels, deeper Fibonacci retracement. So we'll be watching to see. It is still possible we take out that low from divergences, but we don't have to. The VIX was down 9% on Friday or Thursday. I'm sorry, we were closed on Good Friday to test the 20 period moving average, the blue line you see right there. Volatility to calm down, we need to end up dropping back below the 50 period moving average. They're above the 50 period moving average, like we got above it over here. Bad things are happening on the S&P 500. Now, the VIX got potential reversal bar in the weekly time frame last week, and that was a dark cloud cover pattern. That's where price opens higher, gaps higher, and then closes. Usually confirmation is 50%. We did move 50% to the low of the bar, 50% of that bar. Didn't close there, but so it's kind of a sloppy pattern. We do have a bullish piercing, the opposite on the S&P 500, which is a very good pattern. The S&P, it gapped lower, and then it closed 50%. It closed that way, not just the intra-week high, but it closed greater than 50% of the previous week's bar. That's a bullish piercing reversal, the opposite of a dark cloud cover 2-week pattern. Confirm the patterns, though. You got to break down and close below the wide range bar here. That may take some time on the VIX, and the S&P needs to close above that high, that deep down day of the 2-week pattern for the piercing pattern. Now we're pulling back, confirming the pattern yet, so it still needs to be confirmed, but you did get a 2-week bullish piercing pattern, which is a very nice looking pattern with our 8 bar, and now we get the 9 bar with our sequence counts, which I talked about in my last update, linked at the end of this video. Bullish piercing is a reliable reversal pattern, and it is a very good pattern here, rebounding up again greater than 50% of the previous week's candle. But in order for candlesticks to mean anything, you got to get confirmation, and that means eventually we got to get back above the high right here. You got to get confirmation and a follow through. So we got to head back up to the 50-week moving, the 50-day moving average, which is right there. You got to head back up to that 200-day moving average. But a bullish piercing pattern with our 8 bar. Now we get the 9 count. Some positive things, a bullish piercing candle 2-week pattern, our previous week there. Now something else worth paying attention to is the monthly chart. We're getting this bottoming tail. The month was not over yet though, so we'll see how we close the month. But if we end up rallying towards the 200 period moving average and the 50 as they've gotten that death cross by the end of the month here, we're even trying to overthrow that area a little bit. If we set up a massive inverse head and shoulders pattern in the daily time frame, which I've been showing you, if we have a sharp V-shaped recovery, you can get a massive hammer, a massive bullish hammer here in the monthly time frame. If that bullish piercing candle in the weekly time frame holds, then what do we get in the monthly time frame here? Do we end up with the bullish hammer? We'll see how it plays out. Sharp rebound off of our early April low, at least so far. S&P monthly. The S&P for the month is down 5.87%, by the way. NASDAQ is down 5.29%, a little bit less. Again, do we end up with bottoming tails? Do we end up with hammer candlesticks? We had those topping tails back in December. I talked about this in December, and then got the candle of indecision in January, and then got another topping tail. We went slightly higher and got that failed breakout above the December high. Remember, we talked about how we had failed breakouts in the daily time frame on both NASDAQ and S&P 500. So That led to the reversal, and now hitting the opposite, where we had topping tails over here on the NASDAQ in December and February. Now we're trying to set up, and the month isn't done yet, but we're trying to set up a bottoming tail. So again, we end up with bullish hammers by the end of the month. Again, we got a week and a half or so until the end of the month. Rally towards the 200 periods in the daily time frame. You could end up with this hammer candlestick in the monthly time frame. Still may get a bigger pullback. Risk is that we take out the April low, can hold, and the bullish piercing S&P 500 and mark a reversal, a bottom. Then again, this monthly chart may form a bottom with NASDAQ and on the S&P 500. Remember, NASDAQ got the 9 count this week as well, completing it with the 8 bar being the low of the count. It also had a bullish piercing candle pattern. So you have a bullish piercing, again, selling off and then coming back up, gapping lower, coming back up and closing at least halfway through the previous bar. That's a bullish piercing, and that's exactly what we have with both the NASDAQ and the S&P. So potential reversal bars in the weekly time frame, completing 9 counts this week as we've pulled back a little bit after a massive rebound back up, pulling back. We'll see if we set up higher lows now. NASDAQ weekly chart here. I talked about those 9 counts forming in the weekly time frame, and again, we're getting that with these bullish piercing reversal candle patterns. Again, we completed the 9 count. The 8 bar is low the count. Here's the NASDAQ weekly chart, and I covered this in my last update. Wanted to just mention that as we talk about those bullish piercing candlesticks, because again, bar 8 was the low of the count. That very well could be the low at key horizontal support. NASDAQ weekly here, and again, as we got the bullish piercing on the S&P 500, a very nice looking bullish piercing, a very, very good pattern, coming up more than 50% of the previous candlestick. This last week we get the 9 count. So again, I covered that last time, but I just wanted to mention that because we did get those bullish piercing reversal candle patterns here in the weekly time frame. They got to be confirmed. That means getting back above the high over here of the 2-week pattern and getting back above our 50-week moving average, taking us, and that would take us towards our 200 period in the daily time frame.